Welcome, welcome. Well, we got Justin Francis here to talk to us about the low income housing tax credits, or LITHC. This was one topic that got a lot of requests and of additional information, and so we wanted to bring you on, Justin. So appreciate you you joining us here. But just educate us on this whole low income housing tax credit program process, how people are using it, some of the, I would say, advantages versus, called conventional fundraising and build out, and then maybe some of the pitfalls. I think there have been a couple of comments that people have thrown out there. So I kind of want to touch on those pitfalls before we get off the call. But yeah, with that, I do want to turn it over. We got a couple C questions over to you. So maybe we can start with just reading one of those off and let's dig into. I think that'll prompt the conversation further.
Absolutely, and before we get too far in, just for everybody out there, as Leon says, I use the Cinnamon LIHTC, low income housing tax credit, kind of interchangeable, just so everybody knows what that means. And essentially, that means that we're renting to somebody at 60% of the area median income. And the area median income is just that. It's jurisdictional, it's demographic, so it can change and be different. For instance, here in Phoenix, for a family of four, it's $62,000. But in San Diego, it's close to $80,000 for the force, and that's considered 60%. So just so you guys understand that a little bit. So, before we jump into the questions, Leon, let's talk about some of the advantages and disadvantages. And let me just give you guys just a brief history of the program. The low-income housing tax program was brought about with the Tax Reform Act of 1986. At the time, we had a humongous housing need across the country, because you have to realize, after World War II, to solve our housing crisis for all our veterans and growing families, all we did was build public housing. Well, building public housing is not sustainable because it's a government resource and it's not finite, right? So they came up with a tax credit where we can involve private investors like Amex and Walmart, and they can buy in and get a tax credit and to help subsidize this housing. So since 1986, tax credits have been responsible for 3.8 million units of subsidized housing. It's the best program that we have available. It needs to be propped up. Not only did our last two presidents prop it up, President Biden's getting ready to put something in action too. So that's just a quick brief overview on a macro level of the program, how it started. We were under pressure. Public housing wasn't the way. I think at the time we had about 1 million units of public housing, and we needed some help. And the best way to always help is to have what I call a collaboration between the private sector and the government sector. And that's what a tax credit is. Right. It's infusing private capital into these low-income deals to make the numbers work. And in return, that particular investor gets a tax credit, a dollar for dollar tax credit, which can be advantageous if you have a humongous tax liability. Right. If you think about a company, just a smaller Fortune 100 company who has, $30 million in taxes they owe. Well, instead of writing a check to Uncle Sam, they can get with the syndicator, buy the tax credits for, say, 90 cents on a dollar, which will save them tremendously at 30 million. Their outlay would only be 22 million, saving them a whole $8 million for their investors or what have you. So this is what gets the private enterprise and the private business, Amex and Wall. This will get them involved in doing this. And so go ahead.
So building on that, just real quick, just to make sure that I clarify. In that sense, private sector, Walmart, Amex, some of the group, they already have a tax liability to pay to the government. They're already required to pay X amount of dollars in taxes. Now, instead of them having to pay that full amount of X, they instead give it to another private entity who's in essence building government houses for the government instead of the government actually building their own houses.
Yeah, that's a way to look at it. The government said this is our need. These are our people. We can't solve it through public housing. So if we can get some of these private enterprises who have a liability to us, and it's funny, Leon, because the question I get asked when I go talk on panels a lot, particularly in smaller rural cities, they say, well, why don't the government just do it 100%? Well, they need some tax revenue to run the United States. So
right.
They have to balance how much could they even put out in credit. So it's not an resource. And so it's a great resource. It's just not unlimited. And so like I mentioned earlier, the last two presidents had put some things in place to really help and bolster the credit. And so just to your point. But let's jump into before we get right into the business, let's talk about some of the advantages and disadvantages, because I know you guys got some traction with through the Whayle Mentality website about the LIHTC program. And so what were some of the questions that are being posed in regards to the advantage, disadvantage? We're just saying, hey, what are the advantages and disadvantages? Or do people say, hey, this is an advantage, disadvantage, or things like that?
Yeah, Joy, I mean, you saw most of the questions. I mean, go ahead.
Yeah, so we had a couple. Most people are just interested to learn more about the program, right? But we did have one woman on our TikTok page who said she actually works in low income, and she was confirming that the money's there and they're just waiting for people to come and go through the right processes to figure it out. Which is why I think the biggest issue is people are trying to, you know, it's easy to say just do an application, but what does that mean? What is that application? Where do I get that application? What are the things I'm going to need when I'm faced with that application? That way they can be prepared going in. Another question that we got was from someone who's trying to get involved, and she was saying, like, what would be a C or D class apartment building? Because in particular, the clip that did well was one when you were talking about your application process, but the other clip was when I had asked, hey, if I have an apartment building, how do I convert my existing apartment building? And you had said it's helpful if you already have a D or C. So she was saying, what is a D or C class apartment? How would you qualify?
Okay, so a D or C class apartment building, it's very, very simple to find out. It typically is in an area that's downtrodden and the rents are depressed. Okay, so how do you find out rents are depressed? Well, you can go on apartments.com or rents.com and you can type in an address in of an apartment building if you're the owner, or you know what you're charging, but you can find out what the market rate rent is in your immediate demographic, and then in your county. And if you're off by, say, 15 to 20%, I would classify you as a B. If you're off by 20% or more, you're in the D and C range. And a lot of these happens by just years of having them and not enough maintenance and obsolescence, not making sure capital improvement program and keeping these things up, so they kind of fall in disrepair. And by proxy, you start charging less and less rent. Now you're getting more than you were last year, but you're not keeping up with the market. So that's how you would identify if you were an apartment owner and said, now, how do I really know what kind of where I'm at? You know what you charge for your 2-bedroom. Find out what the market rate's charging. And again, if you're in that 20% or under, you're probably in the B range, and 20% or over, 20, 30, 40%, you're in that C and D range apartments. And those are great opportunities to reinvest, because, you know, at XYZ Equity Partners, we can help those who have those C and D buildings and there may be no vices in the LIHTC program. We can partner with you where you won't lose ownership of your particular building, but you'd have opportunity to renovate it and make a little fee while doing it. And so what it's going to do for your asset is allow your asset to go for another 30 years. Now, here's the thing. There's some disadvantages to that. And so let's just be frank about it. Your rents are going to be capped by whatever the area median income is. But you got to think, if you're in a scenario where you got a 30, 40, 50 unit apartment building and you're only getting $700 anyway, what does it matter to you? It's getting ready to go down anyway. So using the LIHTC program to infuse the rehab capital in it and it basically reset that LIHTC for 15 years. You'll have to keep the rent segregated. But two things that happen. One, your building, you add to your building useful life. You add another 15, 20, 30 years. Secondly, you'll get a lot more rents than you were getting the day we came before we started. And so there's kind of two ways to do that. And so I think the advantage is if you're a ailing apartment owner and you have a very small portfolio and everything's, 20, 25 years old, and you're saying, hey, I don't really know what to do with it. We're not brokers, we're developers. We'll help you get it redeveloped in place, and we can take it from there. Does
it have to be an apartment?
I'm sorry.
Does it have to be an apartment? Does it have to be a multi-unit complex, or can you use LIHTC with a home?
Well, here's the thing. You can't use LIHTC. You can use LIHTC on anything. The cost doesn't really justify you doing a certain amount of units. And
for just a home.
Just to clarify, Joey, so your audience is clear at Whayle Mentality. If someone owned like a 30-unit single-family home complex, you could do LIHTC on that if you wanted. But just not like a single-family home or a fourplex. It's just cost prohibitive.
It's just not worth it. Gotcha. Okay.
So you brought up something that I think needs to be highlighted, Justin, when you were talking about, and it was in the answer to, the application process. And a lot of times when I'm advising folks, I tell people to educate themselves enough on the process and such, but there's certain processes that unless you're involved in the item, you might want to outsource. And outsource being identifying somebody who's doing that as a service, or identifying somebody that might be able to bring that subject matter expertise to your own deal. Maybe it's an equity partner, whatever that looks like, but bring that to your own deal, and then allow you to continue doing what you're doing well, while they go ahead and build out the application process, ensure it qualifies, follow the process all the way through for the 10 to 15 year kind of obligation there might be. Is that something that you do or can do with XYZ partners, equity partners? And if not, are there folks that you can recommend that might be able to do something like that?
No, we actually offer that service. And essentially, like you said, a lot of the smaller owners, they might not want to come in and essentially just sell to a broker or sell to us and allow us to go do this. So we can either offer services or we can become a partner. It depends on how that particular venture up. But there is opportunity, and we have the requisite skills. Now, I'm going to be upfront. Each application is at the state level. There's either a state housing authority or there's a finance authority. They're called different things, but just for instance, maybe you're Oklahoma, maybe Oklahoma Housing and Finance Authority. Each state has one, and that's where you would go and understand the qualified allocation plan, which in turn gets you to understand the application and what they're after. In terms of what they're after is these credits, they're pretty precious, as you guys can imagine. And they're a limited resource because the government's saying, I don't want taxes. Let's set aside, 50 billion to put in this program. Well, that's 50 billion less that the government's not getting. And so they're a precious resource. So each state is allocated so many credits times, it's usually, I think right now it's $3.49 times their population. And it's a 10-year credit, so it's pretty powerful. Just give you, for instance, if your state was a small state and they had 1 million, let's say you're going to get 3.4 million. But it's a 10-year credit, so you times that times 10. So really, they're handing out $30 million worth of credits for that year. And so at that point, you look and see, is it worth it to go in for an application if I don't have the necessarily skills or the experience? And because some of the states in the qualified allocation plan, which you all will find out once you take a look at it, that they say, hey, we want to see you done 10 deals before you can apply for our particular LIHTC, because it's such a precious resource. And I think that's where XYZ partners can come in and say, hey, we have the record experience. We've done over 20 LIHTC deals, and we can help you out. We can be a consultant. We can be an equity partner. It's different ways we can help you. And again, if you just want to take a quick look, you know, because it may not be worth our time as well. We're business folks as well. And so, again, like I was mentioning, the QAP kind of sets the rules. And although you have a grade C or D property, and, you know, the QAP may say, hey, this year we're going to look more in the inner city, and your parcel may be more ruralish, or vice versa. And so, but we can quickly look at that, all 50 states, and find out exactly what your parcel is and kind of how it would fare in the overall LIHTC program. And we can do that, you know, as XYZ through the like, again, it could be technical services, or we can be partners. It just all depends. I think what's more important, and why I got into this business, is to make sure that we're preserving the real estate that we have, you know. And so
quick question based off of that. So what I'm hearing is that it's state-based, right? Applications are state-based, even though it's a federal program.
Mm-hmm.
Would you know, what are the states that are easiest, I guess, if this is a good that to get in? So if I'm new and I'm trying to get into LIHTC, I think this sounds great, but I need to have some experience. I have a little bit of experience in property development, or I do have this apartment building. Where's an ideal one place for me to start? I know I need to go look at the state, and what states are best. Which ones typically have a lower threshold? Does that make sense? Like, I'm assuming California is probably going to be like a 10 state in state. So which ones are easy?
Yeah, you know, that's a good question, Joy. And, you know, I think for the most part, people have better luck in terms of just applications received over funded in the flyover states, so the Middle America. Now, problem with Middle America is, because we have quite a big portfolio there too. Problem with it is there's hardly nobody there.
Yeah, that's probably why they're the easiest.
We have properties for rent where, you know, we got people commuting for an hour and a half because our apartments are relatively affordable, and, you know, we're at 85%. You know, whereas I have apartments in Phoenix where it's 100%, you know, they're 100% year round with humongous lists. And so the of ease, just to answer your question, and say you didn't have a property, I just want to jump in the game, I would look at Middle America, find a little town and throw some units in there and kind of learn the program. There's not a ton of participation in the Middle America states. And so I just want to touch on something that Joy just said. Joy, the reason why the government allows the governors of each state, because the tax credit is kind of like it ebbs and flows with the governor. You know, they have 4 years in. So that's how the QAP typically changes. Some states it changes every year to year. Gotcha. Some states every 2 years. But for the most part, up until recently, it was every 4 years. So the governor would come in, you know, and he may be big on veteran and homelessness, and so you'll see projects pointed towards that. Or he may be coming, he's pro home ownership. So now it's a big slant to put the LIHTC on all home ownership products. And so,
I mean, it makes sense when you think about it. Every state's going to have a different type of housing crisis in theory, right? Like they're going to have a different. Yeah.
You know, because what I found out is, like Iowa, I have a project in Iowa, and I got some land in Iowa I'm thinking about redeveloping, or I may not, it all depends. But they constantly have hurricanes. So every year, since 2018, they've had a hurricane disaster set aside. So they're taking their tornado, and they're setting aside a piece for the hurricane county.
Got you.
So if you're in the hurricane county, you kind of got something, it really amplifies your chances for that round.
Got you.
Yeah.
Okay.
Yeah.
So another question was, or did you have a question, Leon?
No, keep on going.
Okay. So
although I was going to say, he said hurricane. I think he meant tornado, right?
Yeah, I tornado. That's what I meant. Tornado.
Yeah. Go ahead, Joy.
Thank you for the clarification, Mr. Lawyer. What occupations have the easiest transition to LIHTC or LIHTC applications? What's ideal transfer?
Well, you know, there's a lot of, you know, I as the what they call the principal developer, there's a lot of occupations I come by, meeting fellow developers. You know, oftentimes architects, believe it or not, you know, finance guys like CPAs. With these particular deals, Joy and Leon, at the end of the deal, the government wants to certify, the state wants to certify you did a good job. So you have to get a third-party cost certification, much like you do in any kind of real estate transaction. And that third kind of understands the deal, you know. And so I've seen a lot of those guys jump over. I've seen market rate property managers who kind of learn the LIHTC client.
Gotcha.
This has happened organically. You know, you're moving along your property manager high level, your principal, you know, brings on 3 or 4 contracts of LIHTC, you clients, and all of a sudden you're a developer. So, so design professionals, property, finance, you know, people who got just a entrepreneurial spirit.
Gotcha.
Those are good crossover.
Now, Justin, with the LIHTC credits, can they also be overlaid on top of other incentive programs? Like, say, for instance, you're like in an opportunity zone. Could you use LIHTC funds and opportunity zone funds on top of each other for something like that?
You can, and the opportunity zone is so new. A lot of the banks and stuff are really scared to use them because the IRS hadn't put out a lot of guidance, right?
Okay.
Go to LIHTC, it's section 42 of the IRS code.
Right, it's set in there.
So it's all the guidance in the world, but OPSO's so new. But to your point, Leon, what I do see an awful lot is LIHTC's layered with historical tax credits. Oh yeah,
Okay.
a lot. And I also see, and this is more of a San Francisco, really urban Dallas, urban Houston. You'll see new market tax credits, which can get you like a grocery store, and then you'll see LIHTC above it. So you see new ground floor commercial. If you see they'll condominiumize, which I've done, and then you go LIHTC prior. So it's very easy to do, but that's a way to double layer some of that subsidy funding. And it looks really appealing to banks. You go and say, look, you know, I got these credits. I basically got $16 million worth of equity. This whole project is going to cost me $21 million.
Right.
You know, can we talk? And they, you know, and I mean, that's different than a market rate guy that says, you know, my bill cost is going to be 16 million. I need a perm note for, you know, 40 million, and I hope to convert. Now, you know, I hope the rents keep escalating up, and you know, and so it's a little different. But yeah, and so those are some of the what I would call the occupations that transition the easiest. And it brings me to another question that I seen on there, and I thought it was kind of poignant because it really reminded me of something that Leon said on the Whayle at the very beginning. You know, it says like, where was someone who wants to start? You know, where would you go? Kind of, what would you do? And you know, I think investing in yourself. I want to give you guys a resource here. There's a company called Nova Grata.
Nova Grata.
Nova Grata.
Can you spell it out?
Yeah. NOVOGRADAC.
NOVO. TRC. Okay. Nova Grata. Okay.
Yeah, and Nova Gradic is a CPA firm, has been in the LIHTC industry since its inception. Michael Novogradic, who was just, I think at the time was he was a CPA at a firm who was trying to start working in 1986. So he immediately pivoted off and started his own CPA firm and became an expert. And for maybe the first 4 or 5 years on any deal that made sense, he was doing the cost certification, and they're very knowledgeable. Now he has a website that's basically a free resource to people who want to get in the LIHTC industry. It has compliance, it has asset management, and it has a whole slew. But the resource that I want to share with you, and as Leon said in that first Whayle, is in terms of investing in yourself. I think for $125, they have something called LIHTC 101. That's like a half course, and it's an overview. And through the overview, it basically, through the overview, you can understand, okay, where do I need to concentrate in at? Where do I really need to really understand first? And they have these different chapters. And so you can take the overview and then start digging into each and every facet of it to bring yourself up to speed. So I want to make sure that your Whayle Mentality audience had that.
Appreciate it.
Yeah, I'm definitely
going to We'll find a way to get it shared out again too.
Yeah, for sure.
So while we have 15 minutes or so, I want to ask, on the other end of the spectrum, what are some of the pitfalls that you've seen people do that have led to either unraveling the tax credit? I'm sure, especially when you start talking about government funding, if you do it too wrong, there might even be fine/jail time. Can you touch on some of the, I would
Absolutely.
say, not to do's in this space?
Absolutely. I've been in this space for about 18 years, Leon, and I've yet to see anybody go to jail. I've seen some
Okay.
humongous fines. I've seen developers be put out of business. And, just to step back, the number one thing that I've seen that gets folks in trouble is the compliance portion, just not having the right folks in there, right?
Yeah.
So obviously, if a syndicator is going to give you 16 of $21 million to build something, they want to make sure they get their credits year over year. It's a 10-year credit. And so what I've seen oftentimes is somebody slips in there, or the property management company's not paying attention, and all of a sudden they got somebody who's overqualified. And so what happened at that point is, and I'm getting super technical, but the tax credits are tied to each unit by year. And so you start taking those credits off, and to that person out of there. And so that's where I've seen people have the most issues. I will say this.
Wait, hold on, Justin. I know you're going to go forward, but I just want to re-clarify exactly what you just said to make sure that everybody understands, because this is going to end about there. What you're saying is that when you get these credits for these, whether it's a pre-existing or you're building, they're attached to each of those apartments. And if at any point in time there's a tenant in that apartment that exceeds the low income threshold,
limit,
that apartment will no longer be a part of that credit.
Right.
And so when you go to bigger people, if you're going out there and you're doing these applications and you're getting big credits or whatever, then now you're out of compliance. Is there a certain number of apartments that have to fall out of compliance before you can get in trouble? Or is it just that if I've sold you these credits and now I'm not getting any benefit from it because you've let people that don't qualify get in?
Yeah, I mean that okay. So just to kind of just remix that a little bit. Essentially, it's only one. So whether you got a 16-unit building, Joy, or a 800-unit building, if you got one person out of compliance, you're out of compliance. And the IRS,
okay, gotcha,
right, can issue you an 8823, 88. It gives you basically a slap on the wrist letter. Now, typically your state agency is the one that does the compliance, and then they kick it up to the IRS, who then has these building identification numbers that's tied to your tax credit investor, who's taking tax credits every year. They kind of know. And so if one person's out, you can get in some trouble. But because this is a very difficult endeavor, the state will work with you to get back in compliance. I mean, I've seen before we took over our own property management, because sometimes that's the best way to do it. We've seen, one guy slide in there, and essentially he was over income, had the whole 42-unit building in jeopardy, and essentially we had to get him moved out, and we paid the move on our dime. Now you can't let the person's lease expire and take it out that way, but
that takes time though, right? But you can't evict them because technically
they're in.
They're not, they're in okay.
Lease, and so. But you wouldn't get the credits. And so what are some of the downfalls of that in the long run? Obviously, the state knows if you want to go get credits again, that you're not doing a great job maintaining the credits they gave you, right? And so I told you guys it was a competitive scenario, so they may dock you a point or two when you go in there again. It's not going to be helpful. And then your syndicator. I mean, after a while, they're taking these credits. If you can't deliver the credits they're asking you, they're going to see if you want to be removed as the managing member, and then get somebody who can kind of manage it. And Leon and myself at XYZ, we looked at buying a general partner's interest, and it was sort of that same scenario. Husband and wife, they were breaking up, but they weren't doing a good job at managing it. So after I called the syndicators, they said we kind of asked them to leave. We asked them to sell their interest in our stuff because we want our credits. They're not delivering. We gave them the money,
right?
And by virtue, they have rights. And so and we'll get
like
into
a cash for keys sometimes, like where
right.
you have to kind of, you
Right.
know, this is the situation, but legally I just need you to go.
Right. And so that's kind of a one way to kind of get yourself in trouble, having somebody in there who's not supposed to be there, and then not working diligently to work on a solution with the state once they figure you out.
Mm-hmm. Now you mentioned something there about how property management might be one of the best ways to kind of to get into it, and even within optimization, when you think of, okay, running these credits, a lot of people would say, oh, you know, it's such a marginal return. Why would you do it? It sounds like, one, it can be capital friendly, because you're getting credits and equity from folks. But then B, it sounds like there's some optimizations that might take place within the business that you can further enhance your revenue / profitability. So one of them being property management.
Mm-hmm.
That itself is a profitable business. You know, many folks out there can attest to that. Now, how would you also use that to then identify or parlay into additional low income tax credit properties?
Well, I mean, you know, think about it, Leon. If you're in the property management game, you know, locally, you're probably part of your local apartment management association, which is AMA, your local building and owners management association, which is BOMA. You're probably part of those things, and you know, you're managing some properties, and you're understanding the compliance of LIHTC. And oftentimes, you know, you have a developer who was moving and grooving. You know, now he's made enough money. He's 50. You know, but those 4 other parcels he had that were ready for multifamily, he's just kind of done.
Right.
You know, he knows you. And if you're out there and saying, hey, not only am I doing property management, but I'm looking to do some development and start, you know, making those introductions at the contacts that you already have because you're in the industry, something's going to pop up.
You know? Yeah, you can see.
Yeah.
You got the tenant. Yeah, that makes sense.
Yeah. So, I mean, that's one way to slide into it as a property management. Another way to slide into it as a CPA or a finance guy or a banker is just like this. The CPAs do the cost certification. They have a pretty good understanding how the money flows and your cash flow situation. So, I mean, if they understand the QAP, they can just jump in. I mean, same thing for a banker. You're going to need a permanent loan on these LIHTCs. I get permanent loans all the time.
Right.
And in the process and sort of what the equity's looking for. And so if they're in a city that I'm not in, or you know, they just may jump in there. I've seen them just jump in there and do it.
Right.
And so, I mean, there's just different ways to kind of slowly break your way in there.
So before we jump off, because I know we're closing out, but because I want us to be very transparent, and you know, one of the things that happens on social media when we share some of this stuff is it may come off as so simple, right? It can be received as something that we're presenting as like, oh, just go turn in an application and you get this money. So realistically, if I'm brand new and I'm just like, this sounds good. If I'm young and I'm like, this may be something I want to do with my career, what am I looking in a realistic time frame and commitment and being able to really do this properly and have the correct understanding to where I'm not getting myself in compliance trouble. I'm not skirting around. Like realistically, what is it to get into?
You know, and it really depends, Joy, on the individual, because like, for instance, if you come out of college and you thinking this is a good idea and your family gives you $1 million, you're rolling. Right? Yeah. Right? Because you can go get land options. You got money for applications. Most applications, Joy, are between $2,000 and $5,000. And let me just say this: each application is about $15,000 to $20,000 to put together. So that's awesome. Let you know, if you're going to take a shot at it, it's going to be $15,000 or $20,000. All right, and you got to have all the experience and everything to actually do in the QAP, and then you'll have to see. Now, how I do to mitigate that is I work in certain states that I really like, that I think I got a great shot at, and there's other things that I look at. And so I want the community to really understand about the program, and if they have any external questions, to come to us first if you're a novice. But it's not as simple as I'm making it seem, but it's not as hard either. And most people don't even know about the program at all.
Exactly.
And it's doable. And I want people to know that it's doable, but I also just, you know, we want to be honest and forefront and not trying to make it seem like it's something that it's not. It will take work, and obviously, like anything, you have
to answer
money.
your question for a normal person, and say a normal person, and let's just talk about a CPA, CPA. Normal CPA says, "Man, I've been doing these cost search for 3 years. I got my CPA license. I really want to get in this." I think from him letting the developers he works with and do the CPA, hey, I want to be a developer, from that to when he's probably doing developments, probably 5 years.
Okay. Yeah, I mean,
and again, and let me tell you what's I think one of the best things about some of these transitional sort of careers is that you have something to bring to the table right off the bat. Right off the bat. I mean, you're right. I mean, the design professional has something. The property manager, they have something to give in the development right off the bat. So that's always good.
So, okay, right. My last question, right before we jump off and say bye to everybody. So I'm a person, I want to get into LIHTC. I don't necessarily have $20,000, but I've done the seminars and I've gone to the Novogradic and I've done all these things. Is there a company or a job that I should be looking for that will provide me an income while concurrently giving me experience and possibly paying that $20,000 application fee? Obviously, it won't be mine, but I can gain that experience and still make money.
Right. I would suggest anybody to in that scenario, if you have or could get in and take that Novogradic class and understand sort of the whole process and where do you think you'll fit in, whether it be property management, the finance portion, if you're a design professional, and then once you figure out if you're a property manager, go get with one of the biggest LIHTC property managers, developers in your area. Because sometimes developers, they do property management in-house. And then sometimes they have separate companies that just specialize only in property management of LIHTC.
Gotcha.
You go there and get a job and start working for them. And
Gotcha.
You'll be in the right sort of sphere for the people who's going to help you when it's time for you to put your application in. Don't be shy to give XYZ a call.
Right.
Gotcha. All right. Well, thank you for joining us. Leon, do you have anything else?
No, I think that's good. I'm sure as people digest this information, as it gets shared, more questions will pop up. We're going to have a couple right. We'll have some golf outing events and whatnot where folks can come mingle, maybe talk about some of your deals, and pick your brain even further. But yeah, definitely appreciate you calling in, sharing knowledge with us. Education is the first E out of the 3. So definitely appreciate you helping us on that mission. So with that, again, appreciate Joy also setting up. Shout out more Will all day. Y'all take care. Have a good one.
All right. You all as well.
See you later. All right.
Take care.